Which car company in the legacy automobile industry is most attractively priced today? We're going to walk through a quick and easy process that you can apply to any industry as you do further research on your own. Let's go. It's great to see you again, you gorgeous 17,000 subscribers. Someday that number is going to be higher, but I appreciate each and every one of you. In this video, I'm going to guide you through step-by-step setting up a comparative company analysis as an industry screening tool. I'd recommend using an even more comprehensive comparative analysis when possible, as in when there are actually comparable companies, when you're doing your deep dive into a specific company's valuation. But for our example today, we're going to keep it simple, since we're just going to use it as a screening tool. Let's say that for whatever reason you're interested in the legacy automotive industry. This could be from some macroeconomic research you've conducted, that's left you with a theory that this industry as a whole is poised to outperform or just currently undervalued. So you're searching for the most undervalued opportunities in an already undervalued industry. Win-win. Or you're concerned about a crash and you've identified this industry as one of the better insulated than others against the specific concerns you have. Right? There could be a number of reasons for wanting to dive into any one particular industry. Or if you want to get more advanced here, maybe there's an industry you just really like. And so you're interested in just really getting to know and understand all the underlying companies in order to ultimately take a market neutral approach on the whole thing. Because you're interested in constantly keeping up with everything anyway. That would be going long the best prospects that you identify from the lot, and at the same time, taking short positions in the worst prospects. Whatever your reason, this is a quick way to determine where you might like to start your deep dives. Now, we're going to be talking about some specific numbers here and valuations. So you have to remember that this is not investment advice. Investment advice would need to be unique to you, to your particular situation. If you're confused about that or have any questions, there's a link in the description to my full disclosures and disclaimers. Anyway, this is very early stages of the research process. Don't take anything I say later in the video as definitive statements about whether or not these stocks are over or undervalued. Instead, it's just whether or not I'm interested in investing my time to dive deeper. I think you'll see what I mean. As long as we're on the same page, let's keep going. Now, if we pop over to Simply Wall Street for some insights on auto manufacturers, we can come over here and select auto manufacturers specifically as the industry that we want to look into. We see that over the last 3 years, they've traded at an average price to earnings ratio of more than 21, or right about 21. It was 21.1 yesterday. And over the last decade, 17. Now today, the industry's trading sub 6. So maybe there is some value here after all. So if we want to dive into this industry specifically, we can pop over to their screener and then filter by the auto manufacturers industry. So that's going to give us now 123 companies. I do want to make sure it's limited to the United States. I want to leave the OTC pink sheets on. I don't always do that, but I'll explain that in just a second. So I need to go in here and change this where it says hide secondary listings. I want to take that off because I want the OTC stocks to come through. And the reason for that is because there are several, for one reason or another, several large major competitors in the United States, legacy auto manufacturers that compete in the United States who are listed over the counter. And you'll see that once we refine our search here. And these are companies that I want to be able to compare against if their valuations are reasonable, if they're not discounted too much because they are over the counter. And that means over the counter simply means they're not on a major exchange in the United States like the New York Stock Exchange or the NASDAQ. I also want to restrict my search here by market cap. I'm going to make it only large cap stocks. Now you can sort through this list to find which of the companies you want as the peer group that you're going to compare as the comps. There's going to be several dual listings here and some companies that, although they're coded as being in the same industry, are pretty different from each other. So here's what I did in this case. I only wanted large cap players in this space. You already saw that filter with the $10 billion minimum market cap. I didn't want those companies who are primarily focused on cutting edge technology they're going to be valued very differently from the legacy players, more like technology companies, than legacy auto manufacturers, which wouldn't allow us to get a clean competitive analysis if we were to include them as well. So that took out Tesla, Lucid, Li Auto, Xpeng, NIO, Rivian. I also took out the companies that are solely focused on high-end cars, like Ferrari, only selling like 10,000 units a year. I did also remove any that were unprofitable, like Tata Motors, which owns Jaguar and Land Rover, as loss-making makes valuation comparisons much more difficult. Now, that left me with 5 US-listed companies, and then 6 more that are also big players in the US automotive industry, but for one reason or another are not sold on a major US exchange, despite being large cap companies. Now, I did separate those 2 groups out at first, so I can be sure there's not too much of a difference in the way they're valued relative to that listing status. And if you don't follow, you'll see what I mean as we go. So after all that, here are the different companies I'll be using. First of all, we have Ford, ticker F, which owns Ford and Lincoln. Secondly, we have Stellantis, STLA, which owns Chrysler, Dodge, Fiat, Jeep, Maserati, Ram, Alfa Romeo, along with several other major international brands. Third, we have Toyota, ticker TM. Aside from its namesake brand, it also owns a few others, including Lexus. It also owns a 20% stake in Subaru, which will itself come up later. Fourth, we have General Motors, GM. It owns Chevy, Buick, GMC, and Cadillac. And 5, Honda, HMC, with its namesake and Acura brands. Then with number 6 starts the OTC, over-the-counter or pink sheets group. There's Nissan, ticker NSANY, which also owns Infiniti and Datsun. 7 is Mercedes-Benz, DDAIF. 8, Volkswagen, VWAGY, which also owns Audi, Lamborghini, Bentley, Porsche, and a few others. 9 is Hyundai, HYMTF, which also owns about a third of Kia. 10, BMW, ticker BMWYY, which also owns Mini and Rolls-Royce. And finally, our 11th comparable company, Subaru, ticker FUJHY. So pretty much with this, I just want to compare as many valuation methodologies as would be reasonable to use with these types of companies. One baseline valuation metric we could use is their GAAP, generally accepted accounting principles, PE, price to earnings ratio. We could look at it both for the trailing 12 months, or TTM, as it'll be notated on our spreadsheet, and for the average of analyst expectations for the next year, or FWD, for the company's forward-looking PE. We could do the same thing with EV over EBITDA, and if you don't know what that is or why you might want to use it, I'll link out to a playlist of short videos I created years ago, walking you through everything you need to know. It'll be in the card and in the description. We can also compare them on a price to book, PB level. And finally, I used price to cash flow from operations, as this is a metric that could be used for almost all of them as well. There are a couple with cash flow issues, rendering this metric useless. I'll illustrate that by just putting a hyphen in their box, which will pull them out of our average calculations. Okay, so now I just need to fill this out. And when I do this, I'll look at a couple different of these data aggregation sites, like Seeking Alpha, Simply Wall Street, and so on, just to make sure that they're telling the same story. If something's off, I might have to go dig into the firm's actual 10K or Q just to get the most accurate read. Or I might just make note of the discrepancy and leave any questionable figure out of our model here if it's not going to meaningfully impact our findings. Now, this brings up an important point that you might find helpful. I don't go digging into the Ks and Qs from the onset. That's boring. It's exhausting. And frankly, it's a waste of time at this point. I do, however, do so before ultimately putting my or a client's money into any investment. I might do it sooner if, when trying to compare opportunities, there are big enough discrepancies between these online automated aggregation tools. So now, because I respect your time, I already pulled in all these valuation metrics for us. Here they are. Now we want to know what the averages for each of these metrics are across our peer group, so that we can see how each individual company compares from a relative valuation perspective to the group as a whole. So let's do that for the US, NYSE, and NASDAQ listed companies and the OTC/pink sheet companies separately at first. here are those averages. Really, my concern with separating them out here is that the OTC companies might be given a greater discount, and probably justifiably so. And if that were the case, I need to know that before drawing any conclusions from these comparisons. But that doesn't seem to be the case here. With all the forward-looking metrics, both groups seem to be in line. And with the PE and EV/EBITDA trailing 12-month metrics, it's actually the US listed companies that have the more discounted valuations on the whole. So I feel comfortable mixing all these comps together to get a more comprehensive competitive analysis at this point. Here are those combined averages. The averages for each of our 7 valuation metrics across all 11 of our company peers. Now this is where it gets fun. Now we want to see how much upside or downside each of these stocks would realize should they revert to the average of their peers. Here's what I mean. If Ford's PE went from where it is today up to its peer average here, that would imply a 127% upside from where it is trading as of this recording. Okay, that looks interesting. In fact, it was Ford's comparatively low PE with its healthy dividend that actually first led me down this path to evaluating the legacy auto manufacturers in the first place. But check out what happens when we apply this same formula to all the rest of the different ways we've chosen to measure value. Here's what that looks like for Ford across the board. Every other valuation metric here is currently reading overvalued. Now we can take an average for Ford of all 7 of these valuation metrics to reveal a relatively close to fair value today, at least according to this very simplistic quick analysis approach. Let's go ahead and drag out this same formula across all our companies here. Again, with each of these, we're looking at their upside or downside potential if they were to revert to the mean for each particular valuation metric. And then we're taking the average for each company across all 7 for a real quick way to potentially identify the most undervalued stocks of the group. After doing that, Stellantis comes out as a big winner here. Really across the board, the company is reading as undervalued. Even if we take out the EV/EBITDA readings, because theirs were exceptionally low, the opportunity still looks intriguing. Now, there's often some reason for this, some factor that is not properly accounted for in these metrics, and that's understandable. It's up to us to figure out what that is. Why are investors treating STLA as a less desirable stock than its peers? Or perhaps, and this is less often the case, but such is the game these days, perhaps we really have found one of those rare value opportunities, a potential undervalued mispriced stock. I'm going to dig deeper to find out which it is. Is there something wrong with it and I should just rule it out altogether? Is it an investment I feel confident in today and now I need to determine position sizing, how it compares to my other holdings? Or should it just make its way onto my watch list to keep an eye on for the future? That's what's next here. To me, it also looks like Volkswagen, one of our OTC stocks, presents an opportunity worth digging into as well, seeing as how it is only displaying upside across all 7 of our metrics. Note, for example, Subaru came out with a higher average of the 7, but when you look at the breakdown, it looks less attractive, as half of the metrics are showing signs of being overvalued, and it's really just the 2 EV/EBITDA figures that are pulling everything else up. If we took those out, for example, like we did with Stellantis, Subaru would not look very good at all. Now, diving deep into stocks is a whole nother beast, and that's the next step here. And that's why I created this playlist with detailed examples using various stocks from various industries. Check it out and let me know in the comments which stocks you'd like to look into next. I'm thinking about creating some quick hit analysis type videos, so not as in-depth as those deep dives, so that I can get more value out to you all. Let me know what you think. I value your inputs. I wish you all the best. Take care.